Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Acadia Realty Trust Annual Report. Acadia Realty Trust is a company that specializes in delivering long-term growth through various business ventures. At its core, Acadia owns and operates a portfolio of high-quality retail properties located in the most dynamic retail corridors across the nation. These properties include street and open-air retail spaces that cater to diverse consumer needs. In addition to its core real estate holdings, Acadia also offers investment management services through its institutional co-investment vehicles. This platform allows for opportunistic and value-add investments, providing a range of options for investors seeking to diversify their portfolios. By combining its expertise in real estate with innovative investment strategies, Acadia is well-positioned to drive profitable growth and meet the evolving needs of its stakeholders. The company's business services can be summarized into two main areas. 1. Real estate portfolio management. This includes owning and operating a portfolio of retail properties across the nation. 2. Investment management services. Through its institutional co-investment vehicles, Acadia offers opportunistic and value-add investment opportunities for investors. The decline of Acadia Realty Trust's stock price by 10.26% over the past year can be attributed to several factors, primarily related to the company's financial performance. The release of earnings reports for each quarter in 2025 played a significant role in this downward trend. In the first quarter of 2025, Acadia Realty Trust reported a net loss and recognized an impairment charge of $6.5 million, indicating underlying challenges that may have negatively impacted investor sentiment. This was followed by another disappointing report in the second quarter, where the company missed funds from operations, FFO estimates. The third quarter earnings release did not provide any significant updates, but the fourth quarter and full year 2025 earnings report revealed a substantial miss on earnings per share, EPS, estimates, despite beating revenue expectations. This significant EPS miss likely contributed to the stock's decline by 4.15% following the earnings release. These financial performances, including missed earnings estimates and impairment charges, cumulatively led to the overall decline in Acadia Realty Trust's stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be categorized into several key areas. Firstly, maximizing internal growth through optimizing tenant mix, executing timely re-tenanting of space, improving operational efficiency, and increasing rental rates can significantly contribute to revenue growth. Additionally, investment strategy plays a crucial role, with accretive acquisitions in high-growth markets and advancing development/redevelopment opportunities, creating new revenue streams. Built-in rent escalations, opportunities to reset below-market rents, occupancy gains through proactive leasing, disciplined cost control measures, and embedded contractual rent growth also contribute to revenue growth. Furthermore, management services and incentive fees from the investment management platform, acquisitions and redevelopment projects, dispositions of non-core assets, repositioning opportunities, and targeted renovation and operational improvements all contribute to a company's revenue growth. On the other hand, revenue decline drivers include decreases in straight-line rents, net losses, increases in depreciation and amortization expense, property operating expenses, real estate taxes, and general and administrative expenses. Impairment charges also contribute to revenue decline. It is essential for companies to identify these drivers and develop strategies to mitigate their impact on revenue growth or decline. The net income of the company underwent significant fluctuations between 2024 and 2025. Initially, it decreased by $16,233, 24.7%, from 2024 to 2025, as reported on page 53. However, this trend was reversed in 2025 compared to 2024, according to page 67. Nevertheless, the net income took a significant hit, decreasing by $49,150,000 from 2024 to 2025, as stated on page 71. The profit margins also experienced changes during this period. On page 53, it is mentioned that the profit margin increased by 12.4% in 2025 compared to 2024. However, on page 67, it is reported that the profit margin decreased from 5.8% in 2023 to 5.7% in 2024, and further to 4.1% in 2025. The reasons behind these changes are multifaceted. Tenant bankruptcies or lease rejections, reduced rental rates and concessions, vacated anchor space, and decreased customer traffic were some of the key factors contributing to the decline in net income and profit margins. The impact of e-commerce on current tenants and future leases, development and construction delays, failure to achieve projected returns, impairment charges for real estate assets, losses from third-party vendor failures, decreased customer willingness to frequent retail spaces during epidemics/pandemics, increased debt service requirements, and higher risk of default on debt obligations also played a significant role in these changes. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The data from page 53 shows that the company has maintained a positive operating cash flow for all 3 years, 2023, 2024, and 2025. Further evidence is provided on pages 58 and 71, where it is stated that net cash provided by operating activities for both 2024 and 2025 are $140,400,000 and $167 million respectively. This significant increase in operating cash flow suggests a strong financial position of the company. Additionally, page 116 highlights that the estimated operating cash flow is positive due to various sources of net proceeds. This reinforces the notion that the company's operating activities are generating sufficient cash to support its operations and growth. Overall, these indicators suggest that the company is indeed generating positive operating cash flow. The company's financial health has undergone significant changes between 2024 and 2025, particularly in terms of its debt level and interest expenses. The total debt increased by $325,420 from $1,547,947 to $1,873,367, with a notable increase in unsecured notes payable and revolving credit facility. However, the mortgage notes payable decreased by $184,968,000. The rise in total indebtedness is evident, increasing by $325,640 from $1,537,266 to $1,862,906. This significant change in debt level has led to a substantial increase in interest expenses, rising by $2.058 million. The company's financial situation has become more complex due to the amortization of property mortgage debt discounts or premiums into interest expense over the remaining term of the related debt instrument. The performance of various segments and regions in the market has been mixed. On a positive note, the development and redevelopment activities have shown strong growth, indicating a healthy demand for new projects. The Greater New York metropolitan region has also performed well, with an impressive annual base rent increase of 44.8%. Similarly, the Chicago metropolitan region has seen a notable rise in annual base rents at 18.4%. However, there are some regions that have shown signs of underperformance or potential risks. The Southeast and Northeast metropolitan regions lack specific performance metrics, making it difficult to assess their current state. Furthermore, government regulations and environmental laws pose a threat to the market's overall performance, particularly with regards to liabilities associated with hazardous substances. These factors highlight areas where improvement is needed to ensure sustained growth and stability in the market. The company's outlook and strategy are centered around growing its core real estate portfolio through investments in dynamic retail corridors. This focus is a key aspect of the company's overall strategy, which also includes expanding its investment management platform to pursue opportunistic investments. The company aims to qualify as a REIT and distribute at least 90% of its annual taxable income to shareholders. In addition to these core objectives, the company is taking steps to manage various risks associated with its business. This includes using derivatives to manage economic risks such as interest rate, liquidity, and credit risk. However, there are also uncertainties surrounding certain aspects of the company's strategy, including the recapitalization of wholly owned assets and the potential for impairment charges. The company's management is aware of these uncertainties and is taking steps to mitigate them. Despite these challenges, the overall outlook for the company appears positive, with a focus on growth and expansion through its core real estate portfolio and investment management platform. The company has made several acquisitions and divestitures in recent years. In terms of acquisitions, the company has expanded its portfolio by purchasing high-quality retail assets in prime locations across the U.S. This includes suburban properties in areas with limited supply, as well as select urban assets in high-barrier corridors. The company also acquired a 48% economic ownership interest in Renaissance portfolio and invested in various shopping centers through its investment management platform. Additionally, the company has made targeted investments in specific retail assets, such as a shopping center in Queens, New York. Furthermore, it has acquired an 18.33% interest in Fund II from two investors for approximately $54.4 million. On the other hand, the company's divestitures have been limited to date, with only one property sale mentioned, a Fund IV property sold in December 2025. However, the company did liquidate some investments due to non-compliance with REIT requirements and also sold shares of Albertsons, generating net proceeds of $14.5 million. The company's financial performance is reflected in its dividend payments and share buyback activities. In terms of dividends, the company paid out $101,335 in 2025 and $76,323 in 2024. This indicates a consistent effort to distribute profits to shareholders. In addition to paying dividends, the company has also engaged in share buybacks through its share repurchase program. This strategy allows the company to reduce its outstanding shares and potentially boost earnings per share for existing investors. By buying back shares, the company is effectively returning value to its shareholders while also maintaining control over its capital structure. That concludes the financial summary for Acadia Realty Trust. Feel free to comment below, and I will be happy to answer them when possible.